LiteFinance, the world of financial freedom.
Hello, it's Monday, July 31st, and it is of course the time to start the market forecast, where we will make analysis of upcoming major macro events and data publications, as well as prepare the fundamental analysis based on which we will create a trading plan, this time for gold. Okay, so as usual, let's start with the calendar, where today we will have a preliminary readings of inflation and GDP from Eurozone. On Tuesday, final PMI readings from last week and the RBA interest rate decision. On Wednesday, crude oil inventories. On Thursday, another round of PMIs from biggest economies and Bank of England rate decision. On Friday, traditionally non-farm payrolls from the US. Okay, that's about it as for the calendar. Now let's move on to fundamental analysis. So financial markets can see some tectonism as the Bank of Japan scrapped its ultra-soft policy. The regulator bought bonds worth of 465 billion yen. It is an equivalent of $3.5 trillion under its quantitative easing program in the past 10 years. At the same time, Japanese investors sold bonds worth of 206 trillion yen, searching for investment opportunities abroad. Now this money will return home, which will affect markets. The gold market is no exception. The balance of power was obvious before the BOJ's July meeting. The supporters of gold felt inspired amid the end of the Fed's tightening. According to JP Morgan, the Fed will start cutting the Fed funds rate in Q2 2024, raising gold prices to $2,175 an ounce in Q4 on average. So whether the landing is soft or hard doesn't matter. If there's a recession, borrowing costs will fall faster, and XAUSD quotes will rise faster without affecting the direction of gold movements. However, the Bank of Japan changed the rules. The yen is becoming the main forex favorite for the next 12 to 16 months, also because of a massive closing of carry trades. However, the global bond markets trend are more important to gold. The BOJ's ultra-soft policy allowed Japanese residents to increase their share in the bond markets of Australia 11%, the Netherlands 10%, New Zealand 8%, and the USA 4%. So they are the largest holders of treasuries, and US bonds rates may grow when capital returns to Asia. In the long term, that can cause a recession in the US. In the short term, growing bond yields and a stronger dollar harm gold. The strength of the US economy also puts pressure on the XAUUSD. It grew by 2.4% in Q2, more than the Eurozone, Great Britain, and other developed regions. As a result, markets are talking about US exclusivity again, which was been a good factor for the USD for a long time. Gold usually loses ground when the real bond yields and the US dollar index rise, which we will likely see in the near time. So, selling gold with the targets at 1,915, 1,880 and 850 an ounce looks relevant. So the situation may change if US macroeconomic stats come in worse and the Fed makes a dovish turn. And so that's it for today from my side. As always, thank you guys for watching, and till next week.